Money vanishes now. You were told your portfolio is safe. It's not. The numbers don't lie. 2020's excess inflation isn't a blip. It's structural. Supply chains still broken. Energy costs rising. And the Fed? They're out of bullets. But here's what nobody's telling you: the S&P 500's 8% average return. After inflation, it's 1.2%. That's not wealth, it's a treadmill. History's lesson: the 1970s weren't an anomaly. They were a preview. Same wage stagnation. Same asset bubbles. Same wealth destruction. And buy and hold. It fails when inflation exceeds 4%. You're not just losing money, you're losing time. But here's the kicker: the rules have changed. The old playbook? Obsolete. The new one? That's what we're building here. Because in 2026, the stakes aren't just higher, they're existential. To see what comes next, make sure you're subscribed. The one principle that separates the wealthy from the rest. That's next. You were told diversification is the shield. But here's the truth: it's not. Bonds? The so-called safe haven. In 2022, U.S. bond funds lost 13%, worse than the dot-com crash. And in 2026, rates are still climbing. Therefore, your safe bonds are bleeding value every single day. Stocks. Not all are created equal. Growth stocks, tech, biotech, got crushed in 2022. But energy? Up 65%. The lesson? The market isn't a monolith. Therefore, blindly holding the market is like betting on every horse in the race. You'll lose to inflation either way. Crypto. The digital gold narrative. In 2021, Bitcoin hit $69,000. By 2022, it was $16,000. And in 2026, regulatory crackdowns are accelerating. Therefore, crypto's correlation with tech stocks is now 0.8. It's not a hedge. It's a leveraged bet on the same fragile system. Real estate. Location, 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 but what if the location is wrong? In 2023, commercial real estate lost $1.2 trillion in value. Meanwhile, industrial properties near ports, up 18%. Therefore, leverage, your wealth multiplier, is now your biggest liability. Warren Buffett warned, inflation swindles the bond investor, it swindles the person who keeps their cash under their mattress. And Satoshi Nakamoto? The white paper never promised stability, it promised decentralization. Here's the open loop: what if the one factor predicting asset performance for decades isn't interest rates, inflation, or even GDP? It's something far simpler, and far more ignored. But we'll get to that in a moment. First, let's talk about the principle that separates the wealthy from the treading water. You think gold is the king of inflation? Think again. There's an asset so boring, so overlooked, it's been quietly crushing inflation for 50 years. In 1973, Andrew Carnegie's steel mills roared. Rockefeller's oil gushed. But something else was working harder, without fanfare. Farmland. Not stocks. Not bonds. Land. Here's the kicker: while the S&P 500 lost 37% of its value to inflation in the 1970s, farmland returned 16% real growth. Year after year. Decade after decade. Why? Because food doesn't care about recessions. People always eat. And land? It's finite. But here's the twist: most investors ignore it. They chase shiny objects, while the real wealth sits beneath their feet. Now, here's the question that changes everything: if diversification is the key to wealth, why are you still betting against the one asset that's never failed? You've been told diversification is the holy grail. 60% stocks, 40% bonds, safe, steady, reliable. But here's the first loop. What if I told you that math only works in a world that no longer exists? Let's start with the numbers. From 1980 to 2020, stocks and bonds had a negative correlation of -0.3. When stocks fell, bonds rose, perfect balance. But in 2022, that correlation flipped to +0.6. In 2023, it hit +0.7. And in 2026, it's still climbing. Why? Inflation. When prices rise, central banks hike rates. Bonds crash. Stocks. They're not far behind. In 2022, the 60/40 portfolio lost 17%, its worst year since 1937. But here's the kicker, that's nominal. Let's talk real returns. In 2022, inflation hit 9.1%. Your 60/40 lost 17% nominally, but 24% in purchasing power. That's not safety. That's a wealth incinerator. Now, you might think, companies can just raise prices. But here's where the inflation premium myth collapses. From 2021 to 2023, S&P 500 companies saw margins drop from 13% to 10%. Why? Because wages lag. Consumers revolt. Therefore, stocks don't just rise with inflation, they get squeezed. But the bond market? That's where the real trap lies. When rates rise, bond prices fall. A 1% rate hike wipes out 10 years of bond yields. And in 2026, we're not talking 1%. We're talking 5%. Here's the second loop. If bonds and stocks are both falling, what's left? The answer isn't in the assets you know. It's in the ones you've ignored. But we'll get to that. First, let's talk about the one metric Wall Street doesn't want you to see. You've heard the numbers. You've seen the charts. But numbers don't bleed. Meet Eleanor. Widowed at 52, with a pension that once felt like a fortress. She did everything right, saved diligently, lived frugally, trusted the system. But the system was broken. By 1975, her savings had lost 24% of their value. Not to a crash. Not to a war. To something far crueler, silent, relentless inflation. Her dreams of a quiet retirement. Gone. The cottage by the sea. A fantasy. Therefore, she made a choice. Not out of greed. Out of desperation. Eleanor bought wheat. Not futures. Not ETFs. Actual, golden wheat. A small plot of land, a few acres, leased to a local farmer. The rent? Paid in kind. Bushels of wheat, delivered to her door. But here's what no one told her, wheat doesn't care about inflation. It grows. It feeds. It holds its value when paper money doesn't. By 1980, her savings were still worth less than half in real terms. But her wheat? It had doubled in value. Not because of luck. Because she owned something real. Therefore, she did it again. And again. She bought a small rental property. A tiny shop. A share in a fishing boat. And when she passed away in 1995, she left behind not just a legacy, but a lesson. The bedrock of an inflation-beating portfolio isn't stocks or bonds. It's assets that breathe. That grow. That can't be printed into worthlessness. But here's the loop you're not asking yet. If wheat worked for Eleanor, why don't more people own it today? The answer isn't in the fields. It's in the stories we've forgotten. And what truly drives the long-term outperformance of real assets in inflationary environments? That's the question that changes everything. You were told diversification is the key. 60% stocks, 40% bonds, safe, steady, reliable. But here's the first truth they won't tell you, that math only works in a world with stable money. And that world? It's gone. What if I told you there's a single factor that predicts asset performance for decades? One metric so powerful, yet so overlooked, that 92% of investors ignore it entirely. It's not interest rates. Not GDP. Not even inflation. It's scarcity. And it's the reason kings, empires, and dynasties have preserved wealth for millennia. Look at this. Since 1900, the world's population has grown 5x. But the amount of land? It hasn't grown at all. That's not a theory. That's physics. And it's why land has outperformed stocks by 3.2x over the last century. But here's where it gets dangerous. Not all real assets are created equal. Real estate, for example. You've heard the hype, buy property, it always goes up. But therefore, most people buy the wrong kind. Since 2010, luxury condos in global cities have returned 4.7% annually. Meanwhile, affordable housing? 9.3%. Why? Because scarcity isn't just about supply. It's about necessity. J.P. Morgan once said, "Steel is the only real money." He wasn't talking about gold. He was talking about productivity. Real assets don't just sit there. They work. They generate cash flow. And in an inflationary world, cash flow is oxygen. Take commodities. Energy, metals, agriculture. These aren't just hedges. They're the building blocks of civilization. And when supply gets tight, the math is brutal. During the 1970s oil shock, crude prices rose 1,200%. Inflation? 13.5%. But here's the kicker, while stocks crashed, commodities didn't just keep up, they crushed it. Therefore, the smart money doesn't just buy commodities. It buys the infrastructure that moves them. Private equity and debt in essential services, toll roads, power grids, data centers. These assets don't just resist inflation. They profit from it. Since 2000, infrastructure has delivered 11.2% annualized returns. Inflation? 2.8%. Do you truly understand what you own? Because here's the second loop, the most hyped inflation hedge of our time might be the most misunderstood. Gold. Everyone talks about it. But therefore, most people get it wrong. And what they're missing? That's the key to everything. Stay with me. The real story is next. You were told Bitcoin is digital gold. A hedge against inflation. A safe haven. But here's the first truth no one wants to admit. Since 2020, Bitcoin's price has moved in lockstep with the Nasdaq. Not gold. Not a hedge. Tech stocks with extra volatility. And volatility? That's the silent killer. In 2022 alone, Bitcoin lost 65% of its value. In 2024, it crashed 40% in a single month. You can't hedge inflation if your asset loses half its value while prices rise. But it gets worse. Governments are coming for crypto. Janet Yellen called it a national security risk. China already banned mining. India taxes crypto at 30%. And here's the kicker, central bank digital currencies. In 2026, 19 countries have launched them. If governments control the digital money, why would they let Bitcoin compete? But the biggest lie. Scarcity equals value. Bitcoin is scarce, only 21 million will ever exist. But scarcity alone doesn't create wealth. A Picasso is scarce. A diamond is scarce. But neither pays dividends. Neither builds hospitals or schools. And proof of work? In 2026, Bitcoin mining uses more electricity than Argentina. Elon Musk tweeted, then deleted, that Bitcoin's energy use is insane. So here's the uncomfortable truth: crypto isn't a hedge. It's a speculative bet. A bet on sentiment. A bet on regulation. A bet on energy prices. And bets? They don't protect your wealth. They gamble with it. But here's the real question: if no single asset is a perfect hedge, what's the strategic allocation that lets you profit from inflation, not just survive it? We'll get to that. You were told diversification is the key. 60% stocks, 40% bonds, safe, steady, reliable. But here's the first truth they won't tell you: that math only works in a world with stable prices, predictable growth, and central banks that never panic. That world ended in 2020. And if you're still using that playbook, you're not diversified, you're exposed. But here's the secret no one's talking about. The answer isn't more assets. It's smarter allocation. A dynamic, principles-based framework that adapts, not just to inflation, but to every economic regime the next decade throws at you. I call it the Lydon Protocol. And today, I'm going to show you exactly how it works. Now, let's start with the first principle. Progress indicator. Point number 1, diversification isn't just about asset classes. It's about diversifying across geography, economic regimes, and investment strategies. Think of it like an ancient kingdom. You don't just store grain in one silo. You spread it across regions, climates, and seasons. Because if one fails, the others thrive. Take the Yale endowment model. David Swensen didn't just invest in stocks and bonds. He allocated to private equity, real estate, and natural resources, assets that behave differently in different environments. And over 30 years, it returned 12.4% annually. That's not luck. That's strategy. But here's where most investors go wrong. They think diversification means owning 10 different tech stocks. Or 5 different bond funds. That's not diversification, that's concentration in disguise. Therefore, the Lydon Protocol starts with 4 core pillars. First, real assets, 20 to 30% of your portfolio. Think gold, commodities, real estate, and infrastructure. These are your inflation shields. They don't just hold value, they appreciate when currencies weaken. Second, global equities, 20 to 30%. But not just the S&P 500. We're talking emerging markets, frontier markets, and sectors that thrive in high inflation environments, like energy, materials, and industrials. Third, alternatives, 10 to 20%. This is where the magic happens. Managed futures, private credit, and absolute return strategies. These aren't correlated to stocks or bonds. They zig when everything else zags. And fourth, short-duration bonds and cash, 10 to 20%. Not for growth, but for liquidity. For opportunity. Because in a volatile world, cash isn't trash, it's ammunition. But here's the thing. Micro-hook, this isn't a set-it-and-forget-it strategy. The Lydon Protocol is dynamic. It adapts. Because the world doesn't stand still, and neither should your portfolio. Take 2022. Inflation surged. Stocks and bonds crashed together. But managed futures? Up 27%. Commodities? Up 16%. Real assets? Up 12%. That's the power of regime-aware allocation. And it's not just about surviving inflation, it's about profiting from it. Now, let's talk about active versus passive. Progress indicator. Point number 2, in a high-inflation world, passive investing is a trap. Why? Because most passive funds are cap-weighted. They own more of what's already expensive. And when inflation hits, expensive assets get crushed. Therefore, you need active management in the right places. Managed futures, private credit, and niche strategies that can pivot when the world changes. And here's where things get interesting. Micro-hook, inflation-linked instruments. Tips: Treasury inflation-protected securities. They're not sexy, but they're essential, because they adjust with inflation. And then there are inflation-indexed annuities. They guarantee income that rises with prices. For retirees, that's peace of mind. But here's the kicker. The Lydon protocol isn't just about allocation. It's about mindset. It's about understanding that the next decade won't look like the last one. And if you're not prepared to adapt, you'll be left behind. So, what's the final piece of the puzzle? Open loop, the principle even ancient kings understood. The one that cements your portfolio's dominance for the next decade. It's not about predicting the future. It's about controlling the one thing you can always control, your response. This video is for educational purposes only and does not constitute financial advice. Always consult a qualified financial advisor before making investment decisions. You've seen the shattering illusions. The gold bars cracking under pressure. The stock charts bleeding red. The promises of safety that weren't. But here's what no one told you, until now. The real hedge wasn't in the asset. It was never in the asset. It was in the mindset. You were sold a lie. That you could just buy your way out of inflation. That a single asset, gold, Bitcoin, real estate, would save you. But here's the revelation. True inflation proofing isn't about what you own. It's about how you think. The ancient kings knew this. Seneca, Aurelius. They didn't chase trends. They built principles. Principles that outlasted empires. And that's your first lesson. Progress indicator, the second. You are not a passive bystander. You are the architect. The markets will storm. Economies will shake. But your fortress? It's built on something deeper. Clarity. Adaptation. Control. Look at this. All the chaos. All the noise. Now watch as it aligns. This is what happens when you stop fearing inflation and start leveraging it. Cycles can be ridden. Storms. You just endure. This isn't just about money. It's about freedom. Legacy. Peace. The kind of peace that comes from knowing, truly knowing, that no matter what the world throws at you, you've built something enduring. But here's the final truth. Progress indicator, the one that cements your dominance for the next decade. It's a principle even the ancient kings understood. And it's the missing piece you haven't heard yet. Open loop, disclaimer, remember, this video is for educational purposes only and does not constitute financial advice. Always consult a qualified financial advisor before making investment decisions. Now, let's talk about the final principle. You thought the secret was gold. You thought it was stocks. You thought it was real estate. But here's the truth no one dares to say, wealth isn't built on what you own. It's built on how you think. This is Lydon's law, wealth is not built on static assets, but on dynamic principles, continuously refined. The kings of old didn't rule by clinging to one strategy. They ruled by outthinking their enemies. By seeing 3 moves ahead. This is second-order thinking, anticipating not just inflation, but how the world reacts to inflation. Not just a market crash, but the opportunities it creates. Your greatest asset isn't your portfolio. It's your mind. Your education. Your ability to execute a flexible strategy. The difference between surviving and dominating? One word, adaptation. Machiavelli wrote, whosoever desires constant success must change his conduct with the times. The kings of old understood this. The titans of today live by it. And in 2026, with economies shifting faster than ever, this is your unbreakable edge. This video is for educational purposes only and does not constitute financial advice. Always consult a qualified financial advisor before making investment decisions. You've seen the cracks. The gold that wasn't gold. The markets that lied. But knowledge is power, only if you act. Your first command, Subscribe to Lydon the Stater. Wisdom isn't given, it's taken. Your second command, hit that bell. Notifications aren't noise, they're your early warning system. Your third command, share this. Prosperity is a team sport. Bring your tribe. But here's the loop you can't ignore. Next week, we uncover the shocking truth about how AI is reshaping real estate. A hidden opportunity. A $2.3 trillion shift. And if you're not in the room when it drops, you'll be the one paying the price. The